All right, what is good, people? It's Max back again with another YouTube video. Today, I'm going to be going over the foundation of my entire trading strategy, what really should be the foundation of your trading strategy. And honestly, this is probably going to be one of the most informational, one of the best videos you're going to watch on applying the AMD model. So if you're new here, hit that like button, hit that subscribe button. Let's get right to it. So if you haven't heard of the AMD model, here it is. If you've already heard of it, great. I'm going to go into more in depth in this video. But yeah, so basically the AMD model simply is a period of accumulation, then a series of manipulation to the downside, stopping everyone out. Then from this point, after the manipulation phase, a distribution phase, where to the higher time frames direction. Now the same AMD model, right, can work to the downside, where we accumulate, right? We would manipulate the highs in a fashion like this, and then we distribute down to the lows. So same thing here, right? We have the AMD to the upside, also the AMD to the downside. Both, right? It doesn't matter whether you're trading buys or sells. It's all it is the accumulation, manipulation, distribution pattern. So this is something important to know. Now, how do we use this in the live market? The first thing you're going to want to do, and there's two key concepts. The first one we're going to do is pair with high time frame fair value gaps. The second is liquidity and LR. Okay, these are the two most important concepts to pair with your AMD. I'm going to be going over both of these right now and how to apply them to kind of this little graph I have. And then in a minute, I'm going to show you guys it in the live market. So, right, number one, pair with high time frame for value gaps. What do I mean by that? What you really want to see, right? Let's say, for example, we have a 4-hour gap right here. So we have a 4-hour, right, H4 fair value gap. Okay, cool. So what you want to see in most scenarios is an unmitigated 4-hour fair value gap resting right here, right? Price accumulates, does not tap into the 4-hour fair value gap until we see a leg to the downside, which then manipulates into it. Then you get an entry model here. If you don't get an entry model here, let's say the dump was really strong, you then wait for us to confirm we're going higher, then you can catch another entry here. But the main idea is that this AMD is sponsored, right, by a high time frame gap. Let's say, for example, we don't have a high time frame gap right there. We have the AMD form where we accumulate, manipulate lower, and then begin to go higher. This is invalid due to the fact that we didn't sponsor the move. This distribution leg isn't sponsored. This distribution leg most likely will not send us higher. Why is that? Because we have an imbalance right below where the manipulation occurred. So what's going to happen majority of the times is that this manipulation looks like it's going to go higher and then ends up going lower down into that gap. Then we get the real distribution. Okay, that's something to keep in mind. So whenever you're trading your AMD model, you always want to see us tap into a high time frame gap. Once again, this can be a 4-hour gap. This can be a 1-hour fair value gap. We're just going to keep this simple for now. Just focus on either one of these as your sponsorship for the move higher. Now, what do I mean by move higher? Because what could actually happen right here, right, is that price accumulates. We go down into that 4-hour gap. Then you look for an entry, look to take a longs right here. But sometimes what might happen, right, let's remove this, is that you look to take longs and then you get, like, let's say, for example, we get like an inverse right here, for example. You take your long and then you end up getting stopped out, or you have your stop like here, and then the price leg goes down and you get stopped out. So this right here would be a trade. This is a classic, right, ifvg trade. This is what we would just call it, right? Classic reversal sequence where price accumulates, manipulates down to a gap. We get an inversion higher. You take your entry, and this actually has a chance of getting stopped out if you don't pair it with the right discretion and the right confluences. The safest scenario when trading these types of moves, right, is to actually wait for there to be confirmation in the play towards the upside. What do I mean by this? Let me redraw. Where'd it go, man? Let me redraw this real quick. So what do I mean by confirmation towards the upside, right? Because price, let me draw this too. Price comes down, right, taps into the high time frame gap. Like I said, once again, you can try to long this move. However, it's a lower probability because there is still a chance that after tapping into the gap and slightly going higher, we can still run down and even invalidate the gap entirely and run lower. So this next thing I'm going to introduce to you is the highest probability scenario within the AMD model. And that's when we accumulate, manipulate into the gap, we fuck around for a minute, then we confirm we want to go higher. What confirms we want to go higher? A huge bullish leg out of this gap right here, kind of looking something like this, where we have a huge bullish leg, right? That signifies that although we accumulated, we then manipulated, and then we've seen a huge amount of bullish momentum enter the market. From here, right after this bullish leg, you then want to see some form of fair value gap form. So we would take something like right here, for example, and you would then just wait for price to retrace into that gap and look for a continuation. So just to kind of base it down real quick, once again, we have our gap, right? We have our accumulation, boom, 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 like this. We manipulate down into the gap. You can look for an entry here, right? However, it's a lower probability due to the fact that we haven't exactly confirmed bias or bullish bias. From here, price may fuck around for a minute, then goes higher, creates that leg towards the upside. In creating the leg towards the upside, we then create a lower time frame gap. So remember, this is either a 4-hour or a H1 fair value gap, right? Sponsoring this move, we then continue to go higher. What do we form right here? We form an M15 or M5 fair value gap. Bang, just like that. Then from this point, you wait for price to retrace into that gap, boom, and then you get a lower time frame inversion, right, out of it, bang, towards where? The ultimate draw on liquidity. So yeah, like that, boom, we inverse, and then you take your, position towards a higher time frame direction. Let's say, price is moving like this. Bang. So all you did was wait for us to retrace into a gap, pair with like a sweep. We go higher, showcases that bullish momentum is in play. We then retrace down into a continuation gap, get an inversion out of it, and you take that entry to probably these highs right there for like a nice 1-to-1 risk to reward, 1-to-1.5. And we could just call that our draw on liquidity. So nice, that's how you'd play that scenario. And that's exactly what I was showcasing down here. You accumulate, manipulate into that gap, and then continue higher, and you catch the retracement in the bullish leg. So make sure I'm recording. All right, cool. Now, next thing I want to talk about, and this is the foundation of the concept. I wouldn't call it basic because it's not exactly basic, but it's the foundation. I'm now going to introduce a concept called LR, which is going to play a massive role in the way these AMDs play out. So once again, liquidity and LR. Well, number one, what you also want to see with a high time frame gap is you want to see us, right, after accumulating. Number one, we already manipulate these lows right here. So that's already a stop hunt. And then you also want to see some form of like a major low on the left. Like let's say price went down, formed a major low and then went higher. You want to see this low right here get taken out. And this is just a major low of price. So paired with, right, when price comes down to manipulate, you want to see us take out that major low, boom, boom. Or if, right, we're trading NQ and ES comes down, takes out low, NQ doesn't, and that makes, once again, an SMT. So two scenarios, right? You either want to see, right, price come down and stop hunt the low. Ooh. Okay, we'll just use this because it's fucked up. Price comes down, right? We have that major low right there, accumulates, manipulates, stop hunts that low, right? Has a sweep on liquidity and then goes higher. Or once again, right? NQ doesn't take that low, but we still tap into the gap, and ES takes that low, giving us that SMT on price. So that's two scenarios you can have right there, which would then present a high quality, once again, distribution, a high quality continuation model, where we would enter right there. So cool, these are a couple things to watch. Now that's the first thing I wanted to touch base on for liquidity. The second thing I want to touch base on, which is extremely, extremely important, is the difference between low resistance, let's lower this font, low resistance liquidity and high resistance. I can't spell for shit, doesn't matter though. Liquidity. So what exactly do I mean by this? Now, in the entire move of the AMD model, you have to focus on whether price is creating low resistance liquidity or high resistance liquidity. First, I'm going to talk about low resistance liquidity. Low resistance. Okay, so let's break down what low resistance is real quick. I'm just going to get rid of a couple of these things just to make it easier for everyone. So what low resistance liquidity is and how we use it to our advantage. Let's say this is the top where price came up, all right, boom, we came up and we formed the top right there. Drag that all the way to the left, right? We're focusing once again on low resistance liquidity. So this is liquidity that's built up into the manipulation. So what you want to see that high, let's say we come back and go to take that high, but we failed to do so, meaning the next candle is lower than that one. Boom. Then this candle comes, this next upward spiral, and we're even lower than that one. Bang. Then this candle goes up, right, and we'll put it like there, and we're lower once again. Bang. And then we go down and have the manipulation. So basically what we saw is that in this whole entire move to the downside, right, in this whole entire leg down into our high time frame gap, into our high time frame sponsorship, into where we're looking for a trade, price consecutively did not break liquidity. Price consecutively did not break highs. Okay, this is what you want to see. This is called low resistance. And the reason why this is so good is because after we say inverse out of this gap right here, if that's the type of setup you want to take, this has a super high probability of playing out. Why is that? Because looking on the left, price has consecutively gone down and not swept out liquidity, has gone down again, not swept out liquidity, has gone down again, not swept out liquidity, has gone down. So right now we look like we're about to go higher. And what do we have? All this liquidity that we can target to the upside. And if you look on the left, we have no liquidity down here. Why? Because all of these lows were already taken to the downside. So these lows right here swept out, that right there swept out. So these liquidity points in the downside are being taken. And if you look at the upside, we have all of these highs right here that are unswept. So that shows that we have a low resistance at our target towards the upside. And now, what basically, right, once again, high resistance, I'm going to introduce this now. High resistance is when we have these lows right here and price comes down, breaking those lows, showcasing breaking those lows that we're taking out liquidity, taking out liquidity. So low resistance is when we're leaving highs and high resistance is when we're sweeping highs. You want to see us sweeping lows in the manipulation down to your gap. Then you want to look for a reversal towards where? The unswept highs. And then you want to see her move higher, take out all of that liquidity. So price, right, once again, moves like this. We go higher, start going lower, start going lower, start going lower. What are we doing in this whole entire move right here? We're consecutively taking out the low, consecutively taking out the low, consecutively taking out the low, right? While what? Leaving this high. Leaving what? Leaving that high. Leaving what? Leaving that high, and of course, leaving that major high. So let's say you want to take a buy right here. Off the bat, there's a higher probability that price is going to go higher from here. And see, if if price truly wants to go higher from this current point where you're taking your entry, it's going to seek all of these liquidity points. Why? Because this is unswept liquidity, and price always seeks liquidity. Why is there a lower probability chance from this point where we're going to continue lower? Because price has done all the manipulation to the downside and none to the upside. This is manipulation right here. This is manipulation right here. This is manipulation right here. No manipulation, no manipulation, no manipulation. We go higher, manipulate, 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 manipulate. Boom. But leading up to this point where you take your entry, which once again is right down into here, all we've done is manipulate lower but haven't manipulated higher, meaning that there's a high probability we're going to go up and take out all of this low resting liquidity above, because this has a lack in manipulation. All right, let's remove all this crap. Hopefully this is making sense so far. Once again, any questions at all, literally hit me on Instagram or comment down below. Now I'm going to go into high resistance, in this scenario, right? So once again, right, to break this down, we're now going to go over high resistance. And keep in mind, this is still an AMD model. This is still an accumulation, right? Manipulation, accumulation, manipulation, distribution. This is all it is, all right? This is all it is. So what do I mean by high resistance? I'm going to go over that right now. Once again, price goes up, all right? And this is a low resistance scenario. Once again, we have all these lows unswept. Now, high resistance scenario, price makes that major high, which is our drawn liquidity, comes down, maybe doesn't hit it, goes down. This one goes and takes it out. It's like shit. Then price goes down, goes higher, that's fine. Or I'll add like another thing in right here where price goes down, right, goes higher. Oh, fuck, how am I gonna do this? Okay, well, we'll just focus on this right here because I don't have enough drawings. But basically, this is a higher, so into your inversion right here, this has a lower chance of playing out, especially if we do something like this. But for the time being, we'll just look at it like this. This has a lower, like you say you take a trade right here, this has a lower chance of playing out. Why? Because if you look at the left right here, what price did in the move down is that we already actively manipulated one of these highs. Bang. So we came up, failure swing, that's good. We would expect this to add to liquidity, boom, then go lower. However, because this is high resistance, price came up, bang, and took out that internal high, and then we went lower. Okay? And then you might get your inversion. And this still might work out, right? But there's a difference between probabilities in these types of models and these types of trading conditions, right? This is a lower probability of the inversion playing out due to the fact that we already actively manipulated a high. Now, if right here, this high is to even go above there, right? Sweeping out that high, there's even a lower probability chance this inversion is going to work simply due to the fact that we took out that internal high plus that major draw, then made the move. So if we're really entering right here, where are our targets of liquidity? That's the first, that's the second. We're lacking targets because into the move to the downside, we already took it out. If we look at the most optimal scenario, it is this, where once again, we have resting highs. So price inverse is right here. What do we have? Resting highs above. We have draws on liquidity that we can hit. All right. So that's that right there. Now I'm going to go into a scenario on the live charts. So you guys can actually see I'm not just talking bullshit here. How do I? All right. I'm just going to remove this for now. So this was a trade that actually occurred today, and it was an A++ scenario. So I'm going to break it down real quick. Once again, I guess I could show you guys on the live charts. Break this like that. All right, cool. What do we have here? We have accumulation, bang. What do we have? Manipulation, bang. Bearish. Manipulation into what? A high time frame fair value gap on what? The 4-hour time frame. So this is a 4-hour fair value gap. Price accumulates, manipulates down into where? A high time frame fair value gap. Price accumulates, manipulates where? High time frame fair value gap. You look for an entry up. Cool. Cool. I'm going to keep this basic, so I'm not going to go crazy in depth on this position, but there's a lot to it. Let's remove these little. I got OCD. All right, now we're going to drop to the time frame lower. All right, and we're going to go back in time so we don't look at all this crap on the side. Cool. So, okay, once again, right, hold on, let's go like this. Okay, so price moves down and comes down and taps the high time frame gap. Now we're bullish. Once again, right, price accumulates, goes down, taps the high time frame gap, bang. Now we're bullish looking for buys. What else did we want to see? We also wanted to see unswept highs into the move down because that means price has an objective to go higher because we're leaving that liquidity. We look at this. What do we motherfucking see? How many times I've been recording for 21 minutes now. What do I gotta show y'all? Look right here. Unswept high. Look right here. Unswept high. Look right here. Asia high. Unswept. London high did get swept out. But look at this. Price goes down into the high time frame gap. In the move downwards, we generate liquidity, and we don't take it out. So going into here where we're looking for our entry, all I see above is targets. And looking below, high resistance, we swept it out. 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 Everything to the downside is getting swept out. Nothing to the upside is getting swept. Showcasing we have no manipulation to the upside and all the manipulation to the downside. All right? So from this point, we want to see price go higher. Okay? Now, what else do we have? High time frame narrative wise, we have unswept highs. Unswept high, unswept high, unswept high. Going into market open, which was right here. Okay, 6:30. So our market opened. What do we have on the left? We have a major area of liquidity here. So if I'm just focusing on this range, which is the most important range, we have our low, bang, and we have our high, bang. All right. Now, what do we want to see happen? We, because of this 4-hour gap, are bullish. So with us being bullish, we want to see what? Accumulation, manipulation of the low, and for us to go higher. The AMD is present on every time frame. Every time frame, you need to see the AMD. Right here. Price is accumulating. Manipulates. Distributes. What do we do in leading to this manipulation? We leave this high. We leave this high. We leave this high. We leave this high. We leave that high. We leave the major high, which is data highs. Let me draw this out. Price goes up, goes down. Price goes up, goes down. Price goes up, goes down, goes up, goes down, goes up, goes down, goes up, goes down. Let me drag this over here now. What do we have? Unswept high 1, unswept high 2, Unswept high 3, 4, 5, 6. All right. Hella unswept highs above. And guess what? Swept lows below. Swept low. Swept low. Manipulation to the downside. Zero manipulation to the upside. What do we have here? Let me break this down one more time. 530. Forex Factory. Pull that bitch up. We had CPI news at 530. What does CPI do? CPI creates a data low and a data high. Data high is a prominent draw on liquidity. Why is data high a prominent draw on liquidity? Because it's a high, it's like a previous day high. It's like a London low. It's like an Asia low. It has significance in the market because there's an imbalance where the high was created with unswept orders from a total imbalance in price from a volatility injecting price, which was 530 consumer price index news. Okay, so whenever you see, whether it's 7 a.m. news, meaning like anything that comes out at 7 a.m. or 10 a.m., right? 10 a.m. New York time, whether you see this 5:30 news happen or you see, 8:30 news happen in New York, and we form a low and we form a high, that is the A plus draw on liquidity. Going into this day, we have our A plus draw on liquidity data highs that what? Edged Asia high right here. The highest point of Asia range is left unswept. Data high comes up, we do sweep out London, but we leave Asia highs. So right here, we have a stacked liquidity pool of imbalance or of drawn liquidities. We have data high and we have Asia high. After data high is put in, we go down, bang. We try to go higher to sweep out data highs, but we create low resistance. And we go lower. We sweep out that major low. And what do we get? What do we get? We get a fucking magnificent inversion on the 1 minute chart right here. Price goes down. We form a 1 minute gap. Bang, bang. 1 minute gap. Is that an even gap? Yeah, 1 minute gap. And look what we do. We go up, inverse. How do we inverse? We inverse with strength. We inverse with strength. We inverse fast. We inverse efficient. We inverse with 88 points. How long did it take for us to go 88 points last time? It took us 1, 2, 3 minutes. You can even count that 4 minutes. And in 1 minute, we engulf the entire move up. We have a V-shaped inversion, V-shaped recovery after what? Sweeping out a low. After what? Being in the 4-hour gap. After what? Generating targets towards the upside. After what? Having data high and Asia high. You take your entry, stop loss at the low. You can put it there if you want to be safe. Take profit at the data high. Take profit right before Asia at the data high. And look at that fucking delivery. Look at that delivery. Couple people took entries right here. Right on that shit. But this is the main idea. These are the types of setups you need to be taking. Holy shit. Once again, I just dropped so much fucking value in this video. My videos get no views. I swear to God, if this video gets less than 100 views, I'm gonna be pissed the fuck off because I just dropped life-changing value today. Now, if this is the first video you're seeing of me and you're like, shit, this is kind of confusing, check out my other videos and take notes on everything I said and you will see how exactly what I just stated plays into every single day, every single scenario, every fucking market open. Every fucking market, I don't give a fuck if it's NQ, doesn't matter. This shit plays. So yeah, hopefully I made that make sense for y'all. I'm finna go get some water. I'm thirsty as shit. I hope y'all have a great day, but if you didn't learn something from this video, I'll send you $100 because you should have fucking learned some shit. And if you already knew this information, fuck you. Why are you watching my video? Go fucking backtest. But yeah, I'll catch y'all boys later. Peace out.